Hello everybody. What a move this week has been, right? I always knew that this week is gonna be volatile because of FMC, but never expected the FX moves to be so exciting this week, right? So post the moves in the sterling, uh, after the mini budget from the Liz Truss government, I was quite interested to find out the FX exposures of the various REITs we have to the FX space. And therefore, in this video, we'll talk about the FX and the rate hike impacts on Keppel DC REIT. This is, of course, the movements of the various currencies that this REIT is exposed to versus a Sing dollar. You can see this year has been really weird, right? You can see the renminbi has depreciated by 4% against the Sing. If the Australian dollar depreciating 6% versus a Sing on a 1 year perspective. So in normal times, these moves would have been quite dramatic already, right? But look at these two fellas over here, the euro and the sterling, right? On a 1 year perspective, the euro is down 13% versus a Sing, and the sterling is down 16%. It's dramatic. And especially look at the move over here, right? This is a 1 day drop in the sterling, and this happened during the new Liz Truss government's proposal on a mini budget, and which turned out to be a huge bank buster. Look at the proposals. It was really dramatic. So what happened? So this is the new Liz Truss government, right, which replaced Boris Johnson after the controversies that the previous government had. And what happened was actually a huge tax cut all over. So they cut taxes on the income tax, reduction in duties on house purchases, and business tax hikes will be cancelled. So in general, the conclusion was that the government revenues will decline by 45 billion pounds over the next 5 years, and all the new proposals will be funded by government debt. So you can see immediately that the financial markets did not like the move, and therefore they pounded the pound and sank almost 3% versus dollar. This is the lowest level since 1985. Right? And last check, the sterling was trading at 108 versus the US dollar. So the impossible is looking like almost possible, right? Can the pound actually trade at parity to the US dollar? Wow, this is crazy, right? It's the lowest level since 1985. So this is history in the making, folks. Um, what is really strange is this weird thing where the Bank of England is doing monetary tightening to reduce demand, right? Because you have soaring inflation, and they cannot do anything about the demand, the supply side. So therefore, they try to whack the demand side, right, to curb demands. But at the same time, the government is doing fiscal loosening, right? So trying to stimulate the economy to boost demand. So it's really strange, right? The bank is doing something, and the government is doing something completely reverse. Really strange, and of course, this is reflected in the valuation of the pound, right? A really dramatic move. So let's talk about the euro now. So if you look at the projections post the hike in the ECB rates recently, and as a reminder, ECB hiked 75 basis points, right? So now rates are now positive in the eurozone in a nominal basis, but of course on a real basis, it's still negative, lah. But you can see that inflation expectation is 8% in 2022, 23 5%, 24 2.3%. So you can see actually these guys are quite realistic, right? They don't see a return to 2% levels until 2025. And of course, this is because of the impact of oil on these guys, right? You can see the economy is projected to be quite weak. 3% in 22, 1% 23, 2% 24, and in general, these guys are too optimistic, right? So I think these guys are gonna end up in a recession, especially if the hike continue to be fast and furious, especially from the Fed. And this is the ECB decision, right? 75 basis points hike from zero, highest level since 2011. But actually, post this hike, rates are still very low. It's like 1% or something. Well, it's still very low by historical standards. But what Christine Lagarde said was that you in general she expected more than 2, but less than 5. So you can see that for the ECB side, they're still quite very conservative on the rate hike expectations. But of course, I've talked about this before. It's due to concerns about the euro fragmentation, right? if you raise rates too high, can every country in the eurozone withstand the hikes at the same time? It's not possible, right? Because the economies of Germany, France, versus Italy, versus Spain, versus Greece are all so different that no one rate hike can satisfy all the economies. So I think the rate hike expectations from the ECB will be more constrained. And of course, we talked about the BOE before, right? There are fears that because of the devaluation of the sterling, the Bank of England will be forced to raise rates even faster to try to combat the fall in the sterling. So I think the England side, UK side will be more difficult to deal with, especially with such a strange fiscal policy. So I was looking at the KDC presentation slides in August, where they showed the status as of June 22, and actually this slide was perfect, right? Because it just talks about everything in one slide. So first of all, let's talk about the FX base. So we want to look at the balance sheet impact. So we want to look at the debt, so the liability side versus the asset side, and see the impact. Actually, they've had it very well covered. So in short, in terms of debt, in the euro terms, you have 42% of their debt in euro, right? But then in the asset side, you just sum up everything in orange, and actually it's just 25%. So they borrowed more in euro debt than the assets they have in the euros. So actually on a balance sheet perspective, a fall in the euro is actually good for them because you have more debt in the euro than assets, right? So a fall in the euro valuation means that they owe less money than before in Sing terms. So actually they're actually well protected over here. Fortunately, I'm not sure if it's deliberate or is it fortunate. But anyway, this looks like the balance sheet perspective. Okay, if you look at the sterling perspective, actually it's the same. So the sterling they have 12.8% in debt, and then they have 6.1% in assets, right? So they have more debt than assets in sterling, and therefore a fall in the valuation of sterling. It's actually good for them. So if you look at the euro and sterling, which has fallen more than 10% on a 1 year perspective, they have in total 42 plus 12, so like 54, 55% of the balance sheet in debt in these two currencies, right? Versus assets of just 30%. So 55 versus 30%. Oh, so actually they are ending up in very good shape from the fall in valuation of the currencies. So actually it's okay. So that's on a balance sheet perspective, right? It should be quite well covered. So on the DPU perspective, actually it's also okay because they substantially hedge their foreign income till second half of 23, right? So next year, right? So I think for the next 1 year, actually the DPU will not really get hit that much because they have actually hedged the foreign source income already. So actually on the DPU front, also okay. So balance sheet front, okay. DPU front, also okay. For the impact on the rate hikes, you can see that they fixed 76% of the debt already, right? And just 24% remaining. And actually what they say is that the floating rates are mostly in euro. So this is quite okay also, right? Because the ECB is not likely to raise rates too fast. I don't think it's gonna happen in the eurozone because of all the problems they have, right? Especially with the Russia situation. So the projection is a 1.6% impact on the DPU for a 1% increase in hike. So actually it's just marginal, right? Not a big deal. In any case, you see that they've borrowed more in euro, right? So actually, when the euro falls against the Sing, actually the interest cost in Sing terms is actually lower. So actually, I think on the balance sheet and the DPU front, it's actually quite okay. Fortunately. This slide also quite good. It shows you the debt maturity profile. You can see, okay, 22 is over, right? So let's look at 23 and 24. You can see that the total debt due for the 2023 and 2024 is just what 12% here and 5% here, right? So like 17% in the next 2023 and 2024. And most of it is in orange, right, which is in euro. So again, we talked about it previously, right? It's probably okay because I don't think the ECB will be hiking rates that aggressively. So actually on the debt maturity front, it's also quite well covered. And as far as the sterling is concerned, well, all of it is lumped in 27, 28, right? While that's 5 years away, right? What's quite good is that they actually issued 75 million euro of a fixed rates due in 28 previously. So this chunk over here is actually quite very well quite smart to have done. Has what 6-year loan in euros and very good rates. So the ICR coverage ratio is also quite good at 9 times. I think the impact on this fella is mostly through the rise in risk-free rates and the discounting mechanism of risky assets. So what do I mean? Well, this chart is the best, right? Look at KDC for the past 5 years, right? It went crazily high to what, $3, and then since then, with the rate hike expectations, you can see this is a very, very, very clear line now, right? It's almost a straight line now, right? And remember, this is the financial markets, right? Where this is not the primary school art class, right? And it's quite remarkable. This move now is almost a straight line, right? Oh, it's amazing. So it's a lockstep movement with rise in treasuries. I talked about it previously when I did a technical analysis of this guy. So I'll put the link over here and you can look at it as well. But you can see that this main way I think this REIT is affected by interest rate hikes. When the 10-year treasury rises to let's say 2%, then you will say your REITs need to yield 4%, right? And then if it rises to 3%, then you say, oh, it needs to yield me 5%, right? So like a 2% pickup, right? And I think this guy is behaving that way. It's just whenever the 10-year rises, then the yield that people demand of this guy will go up as well in tandem, and therefore the price will correct and just go up down and down and down. So what will happen previously, subsequently? Well, I don't know. But if you look at the DPU and our analysis, the DPU will be quite well covered, right? So I think off current prices of 185 and DPU of 10 cents, look at 5.3% dividend yield, right? So is this enough to compensate for a 10-year treasury of 3.5% now? Now it's at 3.7%. Well, I don't know. But this is the main dynamics through which the rise in rates is transmitted towards the price of this REIT. So that's it for this analysis. Hope you enjoy it.